And you know what I'm excited for, Greg?
What's that?
The fact that we're live on Facebook for the Thursday edition of the Not Your Average Investor Show when we do the rental property of the week. I'm your host, Pablo Gonzalez, who is weirdly excited. And with me is the man they call GC because he's just a goodness capsule. And because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Pablo, they're gonna think that me and you rehearsed that shtick right there because that was so money right there, man. You had your lean in going, you had the Michael Buffer voice going. I mean, I'm digging whatever you're putting out there. I'm buying.
Yeah, well, that sounds good to me, man. All right. So for those of you who are joining us for the first time, for example, Aaron Gowen, good to see you, Aaron. We have a couple of things, right? We love to interact with you. This show is about you, especially this Thursday show being about you, right? Like this is heavily educational, and we want you to ask any question that you have about this property, about rental property investing, anything like that. 2 ways to interact with us. Number 1 is the chat, where we see a bunch of people already interacting. And I see what normally happens, right? We forget that when we were using Zoom, there is right in the chat box, right above it, there's a little blue box that says panelists. If you click on that, put in panelists and attendees, now not just me and the goodness capsule can see it, but everybody else, right? So there's a lot of value to be sharing inside the group. So I ask that if you're commenting in the chat, to just take the extra second to drop down panelists and attendees so everybody can see it, and you can all form relationships and give each other advice, and everybody knows what everybody's asking. Yeah, thanks Aaron, you got it, man. And second is, again, we want questions. The chat can get pretty busy. So if you do me the favor of going to the bottom right, popping open that Q&A box, and when you have a question that you want me to ask Greg, or you want me to answer for whatever reason that may be, use the Q&A box. That way I can keep track of it best. I keep track of the ones in the chat as well, but I'm not perfect on it. And then there's also Facebook Live. If you are joining us on Facebook, normally I can sometimes get to your questions, but the best thing to do is here because there's a lot of good stuff going on. And apart from that, Aaron, to your question earlier, if you want to see past episodes of the show, if you want to see Gregg's webinar class that shows you soup to nuts real estate investing, or get our free investor kit and download the spreadsheet that we are going to be tinkering with today for your own tool, we have created a one-stop shop for everybody. And that is it is notyouraverageinvestorshow.com. I'm going to put it in the chat as soon as I am done moving my lips here and speaking, and so that you can have it and just copy paste. But it's a really cool resource. It's originally we only had our Tuesday shows in there. We're now putting our Tuesdays and our property of the week shows as well. And there's also access to our podcast where you can go back and listen to everything we've been doing since the beginning of this year. Tons of golden nuggets. But without further ado, Greg, are you ready for the property of the week?
I'm ready, brother. Let's jump in.
All right. Today's property, 8920 2nd Ave, Jacksonville, Florida, 32208, is a property with 10.5% ROI, and it only requires a $38,500 initial investment. Greg, as I'm pulling it up, I know that there's something that you're real excited about this property. You want to tell us about it?
Well, there's a bunch of things that I'm really excited about. I don't know which one you're hinting at. I mean,
mine has to do with home shopping.
Home shop. Yeah. All right. Well, let's get to that one. But let's talk about the most important things first, which is the return on investment and the cash flow each month, right?
Okay.
We are investing in rental properties and not more traditional assets like the stock market, specifically because you want to earn that dividend each month. You want to get that positive monthly cash flow each month. And when we talk about a 10.5% return and $245 a month in positive cash flow, that's what we're describing. That's what this asset class gives you that you just typically do not find in the stock market. Those returns are basically what you're getting in your bank account on a normal month with rental property investing. And it does not include every profit center. What profit center does that 10.5% return not include, Pablo?
Well, I'm looking down here and I see property assumptions. I see vacancy rate, maintenance rate, and appreciation rate. And appreciation rate is 0. And last I checked, that is a profit center.
That's right. That's right. And last we checked, properties do appreciate over the long haul, especially in Jacksonville. The long-term appreciation rate in Jacksonville since 1991 is actually 4.3% each year on average. And that data is coming from the Federal Housing Finance Agency. So that data point is really significant. If you're looking at your total overall potential profit on a rental property like this, it's actually much higher than 10.5% if and only if what happens, Pablo?
If you're in for a full market cycle.
Gosh, you're so good. So good, brother. So good.
I mean, it's all iteration, right? Like at this point, I've had a lot of at bats on this side of the microphone over here. So let's go through it a little bit, right? So for those of you that don't know, we likely have someone in the future listening to this in their ear. Our friend is listening on podcast. So for people that can't see the visuals that we have on the screen here, right? So address is 8920 2nd Avenue, the 32208 zip code that JWB is well invested in, right? Greg, you guys have tons of houses in this area.
We do.
It is a purchase price of $140,000 is the price of the house. It's a 3-bedroom, 2-bathroom with a driveway, an estimated rent of right around $1,000 to $1,050 and a 2 to 3 year lease. And over here, when I scroll over to the right on the property investor sheet, you see that what we normally focus here on the show, the estimated conventional financing total return is listed at 10.48. But if you include that appreciation that we talked about, Greg, you ready for me to do that?
Let's do it.
Let's do it. So if we put in that 4.3% appreciation, you see that conventional financing total return on investment skyrockets to 26.12. Greg, why did it go up instead of just going up 4.3% when I add that thing in there? Why does it take such an astronomical leap?
Leverage, baby. Leverage, baby. So smart debt is something that can really help skyrocket your return on investment. It can also bring down the timeline of how long it takes you to achieve your passive income goal. And smart debt is taking out debt like today, where you can get a very low interest rate. It's taking out debt on something that pays for itself, like a rental property. Rental properties produce positive cash flow, which means that it pays for itself every single month. And then smart debt is putting debt on an asset that is known to appreciate over time. And this third one is something that a lot of people aren't familiar with. I get a lot of questions about this in our group or from new potential clients coming on board. They say, well, how can I count on home price appreciation? And what everybody should realize is that home price appreciation works in a cycle. And when I asked Pablo, what was that one big if is when you can count on home price appreciation? What's that if? He said, you have to be in for a full market cycle. And that's because if you look at 10 to 20 year market cycles, you will see that home price appreciation rates in Jacksonville and in other metro areas across the country return to their norm. Their norm is what their historical home price appreciation rate is. So if you're a buy and hold investor, the best thing that you can do for your overall returns is to put yourself in a position where you can benefit from home price appreciation. And if you have a very short-term outlook, you really can't bet on home price appreciation. I mean, I can't bet on it in the next 5 years, right? But over a full market cycle, I can. And that's been documented. There's many graphs and data points to show this. The most tangible one, or the most recent in everybody's memory, is what has happened in pricing since 2001. That's a full market cycle, right? 2001 to 2006, prices went way up. 2007 to 2011, they went way down. They went down over 35% in Jacksonville. And many people didn't know this, but what prices have done since 2011 to 2020, if you take the average out of everything I just talked about there, the up, the down, and the subsequent up again, we're still right around 4% average home price appreciation per year. A really important data point for you to value home price appreciation if you are a buy and hold investor in your market.
Yeah, and the other thing I see is, right, like this appreciation number over the long haul, shooting this thing up to 26.2%, right? If I take it down to, will I mess it up if I add to the monthly cash flow, right? Like it's the idea that appreciation over the long haul more than doubles the actual ROI. uh, I know that there is the question of, do I go for max cash flow or do you go for max appreciation? And that's kind of what you differentiate. The Jacksonville marketplace is this safe place that has all the dynamics that provides the cash flow, but it also provides that upside, right, Greg?
Yeah, definitely. If you're a conservative investor out there, that's how I am, right? Has been my upbringing. I was not your standard real estate investor coming out of college. I was working in corporate America. I was not an entrepreneur coming out of college. Like, I'm positioned to be very conservative in my investments. And the reason that made me take such a big leap from working at Johnson and Johnson and thinking about investing in a very different way to throwing that all away and going and starting a real estate company and buying over, we bought over 3,000 properties since then and owning over 300 myself, is because of that perfect balance that you just described. I found an asset that pays for itself every single month in positive cash flow, that I can take out smart leverage and it still pays for itself every single month. And it has a huge upside. That upside is home price appreciation. But if you go too far down the route of just positive cash flow, you're going to give up growth. If you go too far down the route of growth, you're going to give up cash flow. So you've got to find yourself a market where you can get both, where the bills are paid and then some every single month from the cash flow, and you still have this significant upside. And that's why I got excited about investing in Jacksonville, and still do to this day.
It's why I'm excited to be investing myself.
That's right, brother. Did you guys talk about that last week? Did we?
I broke it. I mentioned it last week, and I'm sure we're going to be talking about it as it goes on. Right, the fact that I put a deposit down, and I'm right now in the process of closing of a house. But we're not here to talk about me, Greg. We're here to talk about this beautiful property. I would like to point out, right, as I see this house, this strikes me just visually, right? It is a 1 floor, 3 bedroom, 2 bathroom house. It doesn't look like your typical JWB new construction home. So I'm assuming that between the visuals and the fact that the maintenance rate is 9%, that this is a renovated home, correct?
Absolutely. This is one of our standard renovations.
That's right. So do you want to let's break down. I want to get into the questions here, but I actually, you know what? We can do it through the questions, right? So Leslie Jukovic or Jukovics, I'm not sure how to pronounce it. Welcome, Leslie. That's a new name. If I'm butchering it, let me know, and I'll get better as you return. She puts in, what is the appreciation rate in these areas specifically in Jacksonville, as in this zip code specifically, since 4.3 is across Jacksonville?
Well, I don't have that information for you, Leslie. I don't have the specific home price appreciation in that zip code. And truthfully, what I would tell you to do is to have a very long-term outlook and a very macro outlook when it comes to home price appreciation, right? Because when you go a very short time frame, or you go a very small neighborhood size, the data helps you less and less make the best long-term decisions, right? So I don't have that specific information on that market, but it really doesn't change my own outlook when I buy rental properties, which I'm continuing to do. All right. What I do is I look for the things that really matter for a specific neighborhood, like cash flow. So I'm looking for those neighborhoods where I can earn between a 9 to 11% return just based on the cash flow. And then, assuming that I'm going to be in for the long haul, I'm looking at the overall historical appreciation rate for that MSA, or that it's a metropolitan statistical area. It's basically Jacksonville and a few surrounding little areas there. And those two things really guide you, because the other like individual, very micro data points don't tell you a whole lot when you're thinking about investing for a 10-year or a 20-year hold, in my opinion.
I feel like you sold us short there a little bit, Greg, because you look for other things in a neighborhood, right? Like it's not the zip code appreciation, right? But you look for cash flow. What are the is it 4 or 5 things that you look for in a neighborhood?
Well, we're looking for, number one, we've got to make sure that the numbers work. So we look for the cash flow. We got to make sure that we're surrounded by jobs, right? We've got to make sure that we've got job creators that are right around that area. That's actually a great segue. Were you leading me down that path,
I was
Pablo?
teeing you up. I was teeing you up.
He's teeing me up. The job creators are really important. You have to make sure that the jobs support the housing costs in that area and that people can pay the rent, right? The one way that this model does not work is if either by the numbers, like the demographics and the job base, if that doesn't support people being able to pay the rent, that's how this model does not work. Because people can't pay the rent, nothing good happens for you as a rental property investor. Or if the jobs are too far away, right? So you've got to find job creators that are around your neighborhoods and that support the type of incomes and the support the type of rents that need to be paid in order for this model to work. And we've got a company that I don't know if anybody's heard of that has a pretty big stake in Jacksonville and specifically in this neighborhood right around 2nd Avenue. It's a little company called, what's it called again, Pablo?
It's the name of a river and a jungle, but it's
Nile?
no,
I don't know.
Amazon.
Yeah, so Amazon made big news again in Jacksonville. I posted this in the group, shared one of the articles from the Daily Record here in Jacksonville. Amazon started to build distribution facilities here in Jacksonville in 2017, and it was the single largest announcement of jobs in a day in Jacksonville's history. The first distribution facility brought 1,500 jobs. Months later, another distribution facility was announced that had 1,200 jobs from Amazon. So in the first year, they brought 2,700 jobs, high-paying jobs, to Jacksonville. And what many people don't know is that Jacksonville had to incentivize Amazon to come here. Jacksonville's incentives actually totaled $27 million to get Amazon to come here in the beginning. And that was money well spent. We are all super excited about Jacksonville using those incentives to bring those jobs there. And part of the reason that we do that is because we want people to come to Jacksonville to build that base here and then continue to make investments. We want Amazon to continue to make investments. Well, Amazon just announced their 9th distribution facility. It is about 5 miles away from this house here at 8920 2nd Avenue here in the north side. There we go. Got a map pulled up there, right? 250 Bush Drive right there is going to be the 9th distribution facility for Amazon in Jacksonville. And the presence has just grown tremendously. That's 9 distribution facilities, and it only started in 2017. And the really cool thing is Jacksonville did not have to spend any incentive dollars for this distribution facility, right? Amazon makes this decision because of all the other factors rather than the incentives, which is a perfect incentive plan, a perfect incentive strategy. Obviously there's so many good things that are happening for Jacksonville, and Amazon is paying attention and wanting to make further investments, which is a huge win for you as an investor because Amazon now employs over 5,000 people here in Jacksonville, one of our biggest employers in only 3 years of being here, which is just huge.
And to touch on, so you touched on cash flow, jobs, and I don't want to go too deep because we have a bunch of questions that I want to get to them, right? But what are the other two parts that you look for in a neighborhood?
I don't know which ones you're hitting at.
Cash flow, jobs, crime, like the rating of the neighborhood, right? Like it's not a A or B, it's usually like a C+ neighborhood, right?
Gotcha. Yeah, absolutely. I just didn't know which ones you're hitting at specifically, but you want to be in that below middle income neighborhood. That really goes along with kind of the first point, right? You have to be in below middle income neighborhoods because if you're in below middle income neighborhoods, you're going to be in a place where you have low prices and high rents. And that's when you get cash flow. Like saying it another way, right? Pablo and I were running this morning. It was out by the beach in Jacksonville. You're not going to find any turnkey rental properties where we were running, right? And the reason is not because those aren't great neighborhoods to be in. It's because the purchase prices in those neighborhoods are a lot more than the median income, the median home sales price here in Jacksonville. And when you start to get above the median home sales price is about $260,000 in Jacksonville. You start to get there and above, the rents don't support positive cash flow. And if we were to sell properties to you in those neighborhoods, they would look really great. You would have really nice pictures of them. But every single month when you went to go and pay your mortgage payment, you would be out of pocket if you counted what rent was coming in. You would have more to pay in your mortgage payment than you would in the rental income coming in. So that's not a good deal. That's not a good deal for us. So you've got to be in that below middle income neighborhood, and you really got to learn to love below middle income neighborhoods and everything that comes along with it, right? Positive cash flow is great, but you know what else comes along with below middle income neighborhoods, Pablo, in terms of schools? How do you think schools fare in below middle income neighborhoods?
They're not like the A-rated school system, right?
They're not. They're not the A-rated schools. Crime tends to happen everywhere, but in your below middle income neighborhoods, you are going to have a component of crime. And now that does not mean that you need to be okay with violent crime, right? We do not go into neighborhoods that have violent crime. But in terms of crime happening in a neighborhood, you got to be realistic about it. That does happen in below middle income neighborhoods. It does happen in above middle income neighborhoods too. We tend not to think about it, but some element of kind of that crime of opportunity when people do stupid things, when there's a vacant house or whatnot. I mean, that's real life. When you invest in a neighborhood where you want to get positive cash flow and you want to be in a growth market like Jacksonville, you've got to be okay. If it's going to be good for you, you've got to really value the positive cash flow. That's got to be the most important thing. And then you've got to be okay with investing in a neighborhood that you may not want to live in yourself. And you may not, it just doesn't matter. So you got to understand really what you're stepping into if you want to be a positive cash flow investor in a growth market.
There you go. All right, let's get into some of these questions. Mike Foster asks, on the ROI spreadsheet, is the average annual 4.31% calculated based on only the original appraised property value when purchased, or rather is that average 4.31 compounded year after year?
It's compounded year after year.
So
the way that I get that 4.31% is you go and you look at what home values, the median home sales prices were in Jacksonville back in 1991. That's the first year that they started to have really good data in the Federal Housing Finance Agency's website. And so you go back and you see what that data point was, what the median home sales price was. And then you see what the median home sales price is today in Jacksonville from that data. And then you figure out what was that average annualized appreciation rate to get you there. And that would assume that it grows on itself every single year.
All right, that makes sense. So Medj Garcia, welcome back, Medj. Good to see you again. Asks, why is the maintenance rate at 9%? I usually see 4 to 5%.
Great question, Medj. And Medj, correct me if I'm wrong, but I think you just put another property under contract. So congratulations to you. I believe I saw that when I was looking at the reports. I hope I'm not wrong there, but congratulations to you if that's the case. And certainly a great question here. So maintenance rate at 9%. Now, when it comes to maintenance and vacancy, what you want to do is you want to basically understand what percentage of rents you're going to give up every single year in terms of costs coming your way. Either vacancy costs, which would be costs that, lost rent that you don't get when somebody's not living in the home and paying rent to you, or maintenance costs, which would be things, of course, that you have to spend money on to fix the property. So what most people do when they go in and invest in rental properties, a lot of people don't even consider these things. They have rosy colored glasses and they want to hope that maintenance may not happen or vacancy may not happen. That's a common thing. A little bit more savvy investors would put a number there. But the problem is that they use this industry average, and industry averages can be really misleading because when it comes to your specific property, there are two things that are going to guide what your real maintenance and your vacancy costs are. And they are not based on industry averages. They're based on the quality of the construction or renovation that was done on your property, and then the quality of your property management. And specifically, how long does your property manager get your residents to stay and pay rent until they turn over? How long do we defer turnovers? And no two property managers are created the same. There's a wide-ranging scale of good versus not so good there. So the problem is that a lot of rental property investors use these industry averages. Typical industry average is 5% for vacancy cost and 7% for maintenance cost. But JWB has taken a different approach. We're very metrics based, and we have this incredible amount of data and data points that we can use to make and inform our clients, to make better decisions and inform our clients. So JWB has actually tracked every client's portfolio who has purchased with us since 2011. We've tracked every property. It's been over 2,000 properties. And we look at this every single month. And we see every dollar in for maintenance costs, vacancy costs, and everything else, but definitely for maintenance cost and vacancy costs. And what we've seen is that there are certain triggers that will equate to a higher or a lower maintenance cost. And for this property, if you'll notice there on the left-hand side, you'll see it's on a septic tank. Okay? Properties can either be on sewer or septic. Well, for septic, that adds an element of a new potential cost. And over the years now, for almost 10 years and almost 2,000 properties, we looked at the averages. And we see for a renovated property that's on a septic tank that your maintenance rate is actually 9%. And so this is really important for you, because if JWB was like another turnkey operation that didn't have access to this data and just used 7% maintenance cost, we would be setting you up to fail. We would be setting you up so that we would not most likely be hitting your return on investment evaluations. Because if you put a 7% there, that would increase your expected returns, because that's a decrease to your cost. And the reality is that I don't know of another turnkey operation out there that tracks this. I don't know of another turnkey operation that makes these types of educated expectations available to clients based on whether it's on septic or not. And we do this because we care about delivering on the return expectations that we give.
Very thorough, Gregg. Thank you. Now, Lee Bishop, who has the eyes of a hawk when he's looking at these things, puts houses built in 1940. That is an old house compared to normal JWB inventory, right? Isn't maintenance low for that old?
That's great. I mean, we go back to the data, and it's funny when we say 1940 is an old house. JWB has been building a lot of new construction, especially in the last few years, and so it makes it seem like 1940 is way old when you compare it to new construction. If you looked at all of our renovations over the years, you'd see probably the median house age of our renovated homes is probably 1950. So it's really not that much older. And we have looked at age of house and have wondered if has that gone to a higher maintenance percentage, and we haven't seen that. And it makes sense too, right? I mean, the age of the house is obviously what it is, but when we go in there and we renovate a home, our average renovation cost is over $40,000. So many times we're literally putting a house back together. And so the age of the house is less impactful when you are rebuilding basically houses like we do.
That makes a lot of sense. On a personal level, right? Having come from the construction industry prior to my marketing career, I definitely realized that somewhere before like 1960, all houses were kind of built by the son of a carpenter who's a carpenter, and then at some point in like the 70s, 80s, that started changing, and then there's like the whole glut of houses from like from like 1999 on, and it's more like a 20 to 30 year kind of same thing in these decades, and then same thing in these decades, and same things in this decade. So it makes a lot of sense intuitively coming from the construction industry that 1940, 1950, 1960 is about the same.
Yeah.
All right. So Norma Hauptenstahl, right? And I'm not sure if I'm, yeah, right. So my wife is a fanatic of the German language, so I'm sure that she'd be like, you have to pronounce it Hauptenstahl or something like that. But I'm just gonna say it like that, Norma. I hope I said it correctly. She puts, can you ask Gregg if it's a good idea for investors to pay off rentals? That answer is yes. I can ask Gregg that. But Gregg, is it a good idea for investors to pay off rentals?
Well, that can be a good idea. It can also maybe not be the most advantageous idea. It really depends on what your goals are, Norma. So I'll give you kind of a couple of different scenarios, right? If your goal is to earn the highest return on investment, a big factor of your ROI is going to be how much of your own dollars do you have invested in the deal. And so if you're just strictly making decisions on what your best return on investment is, you're going to want to take advantage of leverage, and you're going to want to keep that leverage in place for the long haul. I mean, thinking about it, if you put down 20, you put down 20%. Let's say that you put down $50,000 today, and then you held onto that property for 30 years, and you just let your tenant pay off your loan for you, and you had no more loan there, your return on investment is going to be off the charts, right? Now, if during that time, if 5 years in there, you paid off that loan, then you would have more capital invested. And overall, your return on that same property would be lower because you put your own money into it rather than your tenant paying off your down payment, your tenant paying off your loan. So your return on investment is largely determined by how much you put into it. So if you want the highest return, putting less into it and keeping the loan in place for a longer period of time is the best on a purely return basis. But we work a lot with clients who don't make decisions just purely on a return basis, right? There are other things to evaluate, right? How much income is coming in is really important. And then as a part of their lifestyle, like when their life really requires it, we might make decisions to increase cash flow and knowingly give up potential return on investment. So when I work with clients and maybe they might be getting closer to retirement, they might share and say, well, I don't have this large active income source coming in anywhere from my job. I want to make sure I supplement that with my passive income coming in from my rental properties. So I want to pay off my loans to do that. Well, that can be the right thing to do for you. It is a way to increase your cash flow, maybe decrease maybe some stress or potential fear, as you enter into retirement. But that does decrease what your return on investment would be. So you really need somebody that, just kind of understands from all angles. That's what we do with our clients. We build a plan as soon as they come on board. Pablo, you just went through this with Mike, I'm sure. And, that plan is evaluated every year or whenever it needs to be reevaluated. And that's how we make the best decision together.
All right. Yeah. So you're right. So not only did I go through this myself with Mike, but we also kind of went through this on last Thursday's call when you weren't here with Mike, right? Because he was the guest star, and we showed everybody how you work backwards from that strategy of like where you need to be and then reverse engineer, which I think is pretty brilliant. So Aaron Gowen or Gowen, Aaron, tell me if it's one or two, Gowen or Gowen. When people want to sell their JWB homes, how easy has it been purely from an exit strategy perspective?
Well, when you want to sell your house, it's a relatively seamless process. But the one thing that I would caution you is that, to get into rental property investing, it needs to be a buy and hold mentality. We recommend at least a full market cycle because that allows you to count on home price appreciation. At the bare minimum, Aaron, if you come and talk to my team and want to invest, we're going to ask you to commit to at least a 5-year hold. And the reason there is because real estate is not a liquid investment, and it has costs that come along with buying and selling real estate. And so we wouldn't want you to be in a position where you buy today, you buy the property at market value today, and then you have to bank on home price appreciation in the short run to be able to get your capital out. Right? That's why the buy and hold mentality makes sense for at least 5 years to give yourself an ability so that you don't have to lose money on the transactional costs. And then long-term full market cycle so you can enjoy the benefits of home price appreciation. So that's the first thing. Make sure you're in for a buy and hold. But when it comes time to sell properties, what JWB is not going to sell your property for you, because JWB works with investors like you, and investors buy on a return. The best way to increase your return on investment, which is always our goal here at JWB, is that you sell and earn the most money on that sale. And that would be selling to somebody who wants to live in the house. So for you, when it's time to sell, we're going to be involved in that decision. We're going to help you understand what your potential would be as far as profit potential, maybe appreciation you've received over the years. And then when you determine that you want to go ahead and sell that property, we're most likely going to advise you to work with a retail realtor. And this is somebody that we recommend for you, that we have a very close relationship with, who upholds the standards of our customer service and quite frankly can get the house sold because they've done that for us literally hundreds of times. So JWB is most likely not going to sell your property for you. We're going to make that recommendation for you. And our clients have had great success being able to sell their houses when they needed to.
All right, buddy. It is 1:06. I know we got to get you out of here by 1:15, and you can leave it up to me to kind of close the comments, right? Like to close at the end. But we have 13 open questions. So I'm gonna try to kind of power through this and pick out the stuff that I think you can answer easily and quickly. Aaron Gowen asks, is Florida landlord friendly compared to other states?
Yes, Florida is known to be landlord friendly. Eviction timelines are relatively quick compared to other states. Takes about 45 days. In a normal scenario, non-COVID, right? We're all dealing with COVID right now, but in a normal scenario, it takes about 45 days from the time you start an eviction till the time that the sheriff removes that individual from the home.
All right. And we got a couple of property management questions here. So Anthony Rayner and Amanda Patch both have property management questions. And Anthony's first one is, can you explain your property management fee? And who does your investors' property management, which is also what Amanda was asking.
Yeah, absolutely. So JWB is the property manager as well. So we sell the assets and we sell them with tenants in place so that you can be cash flow positive from day one. So a huge value for you. We really kind of connect the dots for you. So the property manager is me. The property manager is my team, just as we would also be the people that would be selling you the houses. And then our fees. So typically fees are going to, in the property management world, they're going to range anywhere from maybe 8% to 12% of the gross rents that are collected. That's pretty standard across the board. JWB is right in the middle at 10%. So for $1,000 rent that we collect, we're going to earn $100 of that rent. And we only earn that when we actually are collecting rent. That's something to pay attention to if you're interviewing a lot of property managers. Sometimes they earn the fee whether or not the rent is collected, and we don't want that. We want our goals to be aligned. Another fee that you'll see is a tenant placement fee. This is also very common in the industry. And the interesting thing with tenant placement fees, many people are so fee centric that they only look at what that cost is, but they don't see how long the lease terms are. And a lower cost to a tenant placement fee that's going to turn over more often might actually be more costly for you in the long run. So JWB charges a month's rent for tenant placement. So to keep it simple, for that $1,000 rent, we would charge $1,000 for the tenant placement fee. But our leases are 2 or 3 year leases, which means that we're going to sign that resident day one to a long-term lease. I won't say every other property management company. I can probably count like the number of property management companies that I know of on two pinkies who actually sign 2 or 3 year leases. They just don't do it. And so we sign 2 and 3 year leases. Our average duration of residence stay is actually 54 months. That's a question you'll want to ask other property managers as well, because that's really going to determine your success. And then another fee is a lease renewal fee. This can vary across the industry. JWB charges $200 for every year that we renew. So if we renew a 1 year lease, it's $200. 2 year lease is $400, and 3 year lease is $600. And the great thing about a lease renewals is they literally save you thousands of dollars every time we renew a lease for our owners, because you don't have the new tenant placement fee, you don't have the vacancy cost, right? The lost rent there, and you don't have the maintenance cost that you have to put back into the house to get it into rental shape. So huge win there.
I feel obliged to say, for me, the big eye-opening thing for the property management piece that JWB has is, now that I've seen behind the curtain, I realize that being fully aligned with your investor is the most important piece, right? Like the idea that you're not a standalone property management company that's looking to get rich off of property management fees. You have your property management company there to make sure that anybody that buys a house with you buys 5 houses with you. So it's like minimal pain, minimal takeaway. That's why you go through the hard work of making sure you're only signing 2 to 3 year leases. And, now that I've seen it so much, I feel obliged to echo that piece, right?
Yeah, you want to follow the money when you want to see how people are making decisions. In a normal standalone property management company, 40 to 50% of their revenue is going to come from tenant placement fees, which only happens when they put a new tenant in your house. New tenants in your house mean turnover for you, which means lower return on investment for you. JWB is different. The vast majority of our income comes from home sales. And so property management for us needs to further more home sales, which is exactly what you were just talking about, Pablo. All
right, super. Paul Rogers asks, how has the pandemic affected real estate investments over the past 6 months in Jacksonville?
It's interesting. When COVID broke, nobody really knew what was going to happen in a lot of different areas. But we came really strong. And while others might have thought that prices would have gone down, we went really strong and we said that prices weren't going to go down. And that's actually what's happened in Jacksonville. Prices have actually gone up in Jacksonville. And the reason is because there's been such a huge increase in demand and limited supply of houses here in Jacksonville. So prices have gone up, rents and rent collection has been incredibly consistent. We've collected over 97% of rents every month since COVID broke. I do an update for our group and for our show every month, and it's over 97% of rent collect every single month. So this is an asset class that people came to prior to COVID because of consistency, because of that monthly dividend, which is the rental positive cash flow coming to you every single month. And then in a world where COVID broke and everything was turned on its head, this asset class, single family rental properties, has been performing incredibly well. That's not just JWB here. If you talk to other operators in the space, they'll tell you the same thing. It's been a shining star for all investments out there.
Awesome. Anthony Rainier asks, I see you list a non-recourse loan. Is that something that can be used in a solo K?
Yes, absolutely, Anthony. Non-recourse, you should just equate that to buying in your retirement account when you see non-recourse. It doesn't exactly mean that, but that's the majority of the applications for our clients. Non-recourse is a specific type of loan that you need to be able to get leverage when you're buying in a qualified plan. A qualified plan would be an IRA, a solo 401k, those types of retirement account plans. So yes, absolutely.
All right. Dominic Albano asks, is this info based on 20% or 25% down payment? I should not have taken this thing off yet.
That's a great,
Greg, talk about
that's
it
a
while I
great
bring
question. Dominic's, I believe, a current client of ours. So welcome, Dominic. Thank you again for your trust. So yeah, this is a great tab. If you want to just zoom in there up at the top there, this is really cool. For anybody who hasn't downloaded the Investors Toolkit that we offer, you can mix and match and play with these numbers like Pablo and I are doing right here. This is available. You can go to notyouraverageinvestorshow.com, and there's a place right there where you can sign up for our webinar, and you get this as our free gift. Those assumptions, what was in there before you moved that, Pablo, was 25%. So all of the numbers that we've been sharing with you have been based on 25% down. That 10.5% return on investment was based on 25% down. It's based on a 4% interest rate. And yeah, if you adjust it down to 20%, you can see that the number shoots up to 11.9%. Something else to pay attention to is, again, I know it's hard for investors out there. If you're comparing different markets out there, you want to see what's comparing apples to apples. Many other turnkey providers do not include closing costs in their return on investment calculations because they're just searching for ways to get the highest return to put in front of your face. We still include closing costs. Either if it's 25% or 20% down, we're going to include those closing costs, which actually is real. It happens. You have to pay those every time you buy a house with a loan. And that actually decreases your return on investment, which is great for us because it's realistic and we want to hit that return on investment.
All right. Dominic also asks, vacancy costs and maintenance costs are held by who? Buyer or management company?
That's another really, really good question. So those vacancy and maintenance costs are there as a conversation topic with you to prepare you in advance. We don't escrow those for our buyers. We would advise you to do that. Keep those funds, a small amount of funds, and maybe a separate bank account as a rainy day fund, especially if you only have one property, or if you're newer into this, keep that there so you're not surprised by any unforeseen maintenance costs. But that would be on you. It's not housed or escrowed by JWB.
Okay. Real quick, I'm trying to find stuff that I can't answer here, but Roger Evans asks, what is put in place to educate the renter on how to maintain the septic system?
A lot of education. It starts really with the lease signing to make sure that they understand that there's a septic tank there. They understand that if they cause the issue that they're going to have to pay for that. It's pretty easy to see for things that, would cause a septic tank to go bad. It's pretty easy to correlate that to the resident's activity. So it starts there. There's a training process during the lease signing. We make sure that it's explained, it's signed and initialed. And then through the process, if there are issues that might come up during the time that they're a resident, we're always trying to help that resident solve either their own problem without us having to bring a maintenance vendor out there, which would cost you money. So many times residents can solve their own problems. Might not be with a septic tank, but many other issues, right? You don't have to send a vendor out there every single time. So there's a lot of education that is done throughout the renting process as well.
Greg, I know you got to get going, man. So I just want to welcome everybody to join us on the Facebook group at jwbfacebookgroup.com, where Greg hangs out on his spare time. And you can get a lot more of these questions answered. There's a couple here that I feel pretty confident answering, right? Like it's stuff along the lines of like the Jacksonville economy, things that we've talked about a bunch in the past. I'm going to go through it, but if there is anything that you haven't gotten answered, the best place to go is jwbfacebookgroup.com and ask Greg and the other 1,700 investors that are part of our Facebook group in their really, really good questions and answers. It's kind of like one of these chats, but on steroids, with a bunch of other content, right? Like we repurpose other contents. Greg does a walk and talk in the morning. And again, if you want to catch replays, if you want to see other things of the show, go to notyouraverageinvestorshow.com. I know you got to go, buddy. If you want to, I kind of want to give it up to you to say goodbye to the folks and thank them for being with us.
I just appreciate everybody being here. It's such an honor to be able to spend this time with you guys, and so freaking cool that we run out of time to answer questions. It's amazing. If you had been there day one with Pablo and I, it's just really fun to be here. So I do have to run. I'm sorry I won't be able to spend that time with you guys today, but I do want you guys to use the group as a resource. And, anytime that you post a question in that group, I'm going to make sure that I get you that answer. Even one last week or 2 weeks ago that was posted, I just did a special little walk and talk there to answer that question for that client, Abraham, who had that question. So I'm happy to do that for all of you who have those questions. So please use that group. It's not only right now that you have access to getting those answers. It's all the time when you join the group. So hope to see you all there.
Greg, this was super fun. Next week, so I'll let you go. You can click off, and I'll tell everybody about next week's shows, and I'm going to kind of go through some of the stuff here. Have a good one, buddy.
Appreciate it, everybody. Take care.
So I'm just going to kind of scroll through some of these questions that I know how to answer, right? So I see, Marilyn, you have a question about the contract for Amazon distribution and a couple of like bigger picture, what happens in 3 years when the world slows down and is healthy again? Will people still have a need to order so much online? Will Amazon move out of town? I think those are one of these opinion questions, right? Like, I don't think anybody has the answer to that. I do believe that I come from the Amazon e-commerce marketing world, and it's pretty clear that e-commerce right now is only about 12% of total purchases. And as COVID has hit, we've seen this rapid acceleration of move to online and move to convenience. And I don't think that e-commerce is going anywhere. And Amazon, you'd be surprised how little the actual footprint, while Amazon actually controls like 40% of all online commerce, still the stuff that we buy online, at least last year, I don't know how much has changed in COVID, was only about like 15% of overall retail. So the idea that anything that saves us time is going to go away, right? Like we all value our time immensely. So anything that saves you time, think about Alexa or think about Google Home. Like we all know we're giving up privacy just to save an extra 15 seconds to turn the music up, right? So e-commerce is a growing trend. It's not going anywhere. So I believe it's only going to continue, right? Like as their logistics get better and people buy more and more online and the lessons learned from COVID, I don't think that that's going anywhere, especially not these distribution centers. At the end of the day, they're getting these big cargo ships from Jacksonville coming in at a perfect entry point in the Eastern Seaboard that distributes everywhere else. Ted Pang, I see that your question is from 1252. So I'm assuming it was when we were talking about the Amazon Center, and you ask, how is services such as banking, insurance, healthcare, information services, manufacturing, biomedical technology, and logistics? And I'm assuming you're talking about affecting the overall Jacksonville economy. And those are really, really good sectors to call out, right? Because those are really healthy, insulated sectors that are always there. And Jacksonville actually performs really, really well in those. Jacksonville has a really, really blossoming fintech ecosystem, right? We actually have 2 Fortune 500 fintech companies that have their headquarters here. FIS is the most recent to come here. That was a big announcement. I think like 3-4 years ago, they're building this huge headquarters in downtown. Everybody's really, really excited about it. Healthcare is another really, really big sector here. Logistics is another really, really big sector here. As I said, we were positioned uniquely to serve the Eastern Seaboard and the Southeast. What else? Insurance, Florida Blue, who's one of the biggest insurance providers, has a headquarters here as well. So all the signs, and we've actually had past shows on the Not Your Average Investor show where we brought in the president of the Chamber of Commerce, Daniel Davis, the president of the Jacksonville Transportation Authority, Nat Ford, to talk about the economy at large. And next week is going to be a little bit of that, so you may want to tune in. But it's a really, really healthy economy. And one of the big blossoming sectors is actually smart cars and self-driving vehicle technology. There's a really big investment happening here because of a project that we discussed with Nat Ford and the JTA, where they're taking this old monorail kind of system, turning it into a highway above the ground, and then connecting it to on-ground lanes where completely autonomous vehicles are going to run. And it's at the level, the testing of it is already at the level where during COVID, they were able to use some of those autonomous vehicles to deliver COVID samples between healthcare facilities, completely automated. Level 4, which means no driver on the car whatsoever, completely trustable. And that's going to be a whole nother fallout of a whole new economy where we're getting a lot of investment. Roger Evans asked, as the house is renovated, what if any maintenance modification was done to the septic system at the time of renovation? Roger, I'm going to take note of this question and I'm going to have Gregg answer it in the group. Let me just copy paste real quick so that I have it to send it in. Roger Evans. So I don't want to, I don't want to pretend like I know anything there, right? I think that's a good one to get from Gregg. We answered the maintenance system. Manvir Badial, has new construction slowed down or maintained as usual? Manvir, I can tell you that right now there is still a much higher demand for housing in Jacksonville than there is supply. So there is new construction happening everywhere. It's going gangbusters. And I think it's a bunch of trends that are happening right now, right? Like the trend of people moving into warm weather climates was already happening. But now with COVID, we're seeing a ton of people, thanks, Guillermo, a ton of people coming down from heavily populated cities in the Northeast, like New York and Philadelphia and stuff like that, and just coming down to Jacksonville now. Right. So people from Miami, that is more heavily densely populated with a higher cost of living. I'm one of those sample sizes that came up here to settle. So there is still, and the months of inventory, right? The statistic that JWB tracks to understand short-term market demand, the equilibrium number for Jacksonville is about 7-8 months of inventory, meaning that if nothing comes on the market, based on the demand, all the houses sell in the next 8 months. Right now, MOI, months of inventory, is at like 1.2 months, something like that. So there is an elevated demand and a reduced supply. So new construction is alive and well in Jacksonville. Norma Hoptenstahl, is a 40% renewal fee considered high for vacancy, or does it depend on the market? Not sure if I'm asking this question correctly. Norma, I'm not sure I can answer that question correctly. So I'm going to copy paste, put it here, and have Gregg answer it in the Facebook group. And I hope you join us in there. Anthony Rayner, I'm an investor in Memphis, Tennessee properties. What would it take to purchase properties in Jacksonville, Florida in my solo K? And would JWB help provide guidance on the paperwork my LLC would have to fill out? Anthony, that's a big old yes, my friend. What you got to do is go to, I'm going to put it here, chat with JWB.com. I put it in the chat. If you go to chatwithjwb.com, you pick out a time, you get on a call with the Mikes and Courtney and the team that onboards, and it's a very like, as you're seeing in the comments here, I just bought my first rental property here with JWB. It's a really informative process, right? Like, so they are really there to answer your questions. They have everything figured out to either refer you to the right person or do it themselves or give you the best advice possible. So that would be the move there, Anthony. And we'd love to have you on board here, man. We got a Memphis attendee here. Is he still here? No, he's gone. So I'm not gonna talk about Memphis right now. Miguel Angel Sanudo, is it okay to also consider also location related to noise, highways, trucks, parks, trains, lines, smell ponds, garbage centers? Miguel Angel, I don't know the answer to that. I think you are in our Facebook group though. So I'm going to put it in here and ask Gregg to answer that question. I also saw you ask if it makes sense to have a diversified portfolio between new construction and existing construction in the chat. And obviously I'm not the expert, right? Like Gregg is more the expert, but I'm keenly attuned into what we've been talking about here in mass, and like what the sales guys go through and the education that they want for everybody. And I happen to know that they see all of the properties that they offer, they just see them as widgets, right? Like that return that they're selling at the end of the day is the product that they sell. And their new construction versus renovated property, they have the same amount of confidence in that ROI number at the end that they're really selling you, which is really what you should be looking at and purchasing, one to another, right? So at the end of the day, the numbers that reach that 10%, 11%, whatever it is, like today's property, the numbers that get you there differ, right? So in the renovated property, it might be 9% maintenance rate, while new construction property might be 4%. But all of those costs are thought of ahead of time to then get you that back end number. So it sounds like diversification is a great term. But as far as the JW inventory, they see that final number at the end as really the product, and that's what you want to be betting on, right? So I would encourage you to think of it more as, how much do you want invested into your rental property portfolio as that one asset class of your long-term safe asset that's going to return at X. And then what else do you want to take different risks on? Because the risk within the JWB portfolio is very equal. And does JWB offer management for houses bought out of JWB? Yes, Miguel Angel. So JWB's property management company does manage properties for other folks in Jacksonville, right? They're all in Jacksonville, and they're all within certain neighborhoods, right? So one of the things that Gregg talked about in the neighborhoods that they invest in is that they're not perfect, right? Like there's not no crime, but they're also not violent crime neighborhoods, because they've realized that the tax on the property manager to be able to take care of your property correctly so that they can live up to those expectations that they set is not feasible when you go into the violent crime war zone neighborhoods, right? So I know that they do manage properties within Jacksonville for people that aren't JWB clients, that aren't JWB investors, but they're only managing it. They don't manage in certain areas. So that's your answer there. And that's it. This is my first time taking questions like this. Miguel Angel, happy to answer. Anthony, thank you for coming. Thank you for being here. I'm the fact that 40 people, plus joined this call on a Thursday afternoon to spend time with us and pick our brain and be a part of our life is something that I never take for granted. The idea that I can sit here in front of amazing people like yourselves that are trying to accomplish great things to add value to your life, and even without Gregg, answer a couple of questions after being here all year, learning this stuff right alongside is truly an honor. So thank you, Guillermo. Thank you, Medj. Thank you, Miguel Angel. Thank you, Anthony. Who else is in here? Thank you, Marilyn. Right. Thank you, Lee. Thanks, thanks Roger for coming here. And thanks, Leo. Thanks. I appreciate it, man. And that's it. So Tuesday's show, we're bringing in, you may know him by name, Alex Zafakis, right? The other co-founder of JWB, Gregg's original partner, of which, now there are 4 partners. He is the visionary of JWB, right? Like Alex is the guy that's looking. All right. So a little peek behind the scenes. JWB has 4 partners, and they all have like very specific kind of like superpowers, which is something that I've noticed and I think is really interesting. Alex is the dreamer, right? Gregg is the guy that kind of brings order and calm to the force, right? So he specializes in talking to existing clients. Alex is kind of like the face of the community because he comes up with these big projects. And then there's the Adams, right? One Adam Regal is the finance guy. He's the CFO. And then Adam Eisman, that they call ICE, he's the operator, right? So he's the CEO that's running things. So we're bringing in Alex because, as you may or may not have heard, JWB is developing these. First of all, they're very involved with downtown, with the downtown core that's about to blossom. And they are developing a shipping container apartment complex, right? So this has caused a lot of headlines. We know that every time we say, at least here in town, when I say that I work with JWB, people are like, oh, shipping containers. And they're super, super interested in it. And we get a lot of questions on them. And it doesn't really, it's not a direct, it's not something that investors can invest in, right? But it's going to give you a peek behind the curtain of like how JWB operates and how they think long term. And you're going to get to have all your questions answered about these shipping containers and about the future of downtown. And really, I'm going to give away the the really lesson to learn is, a lot of people often ask JWB if they're going to move to other markets, and they always answer, no, we are in Jacksonville for the long run, right? Like, you don't have to worry about investing in Jacksonville and whether we're going to be here in 30 years because we're all in. So I think that this is going to be very, very educational on just how far out their vision is for Jacksonville and how the shipping container not only is good for JWB, not only is it good for the community of Jacksonville and what is happening, but also why it actually is good for investors. So I invite you all to join us on Tuesday for the Not Your Average Investor Show with Alex Safakis. He's kind of a wild card. I have no idea what he's going to say, but he's a really, really compelling dude. So thanks again. Thank you all for being here. I hope to see you soon. I hope to see you in the Facebook group. And until then, take care.